Sustainability-linked bonds face a hidden grid infrastructure risk. The infrastructure risk hidden in electrification KPIs. When a sustainability-linked bond or loan ties its cost of capital to an electrification milestone, it assumes that electrification is within the borrower's control. Grid access constraints are challenging that assumption in ways the original structures didn't contemplate. Sustainability-linked financing has grown from a niche instrument to a mainstream corporate finance tool remarkably quickly. Global sustainable finance issuance remained remarkably resilient through 2025, reaching $2.2 trillion for the year, just 1% shy of the record set in 2024, despite intensifying political and regulatory headwinds. However, the specific segment of sustainability-linked bonds, SLBs, and loans, SLLs, faced a challenging transition as the market shifted toward more established green and social labels. The appetite among institutional investors and the favorable terms available to issuers created strong structural incentive to use them. What the structures didn't fully anticipate is what happens when the milestones they're tied to depend on infrastructure the issuer doesn't control. How electrification-linked KPIs and sustainability bonds depend on grid access, nobody guaranteed. Many sustainability-linked financing structures include key performance indicators, KPIs, tied to electrification, reducing Scope 1 emissions by converting thermal processes to electric, achieving a specified percentage of fleet electrification, or hitting energy consumption targets that require grid access to new or expanded facilities. These milestones were designed to be ambitious but achievable, based on assumptions about the pace of electrification that in turn assumed grid access would be available when projects were ready to proceed. In the current grid environment, that assumption is being tested in concrete ways. A company that issued sustainability-linked debt with an electrification milestone tied to a specific emissions target may have a project ready to execute that has been sitting in an interconnection queue for 2 years. The milestone date approaches. The project isn't energized. The issuer faces a penalty, typically a step-up in interest rate of 25 to 50 basis points, for missing a target that was effectively blocked by infrastructure. It had no direct ability to accelerate. Moody's noted in its 2025 ESG credit analysis that a widening gap between decarbonization ambitions and actual implementation represents a growing credit risk, particularly as heightened investor scrutiny over the credibility of SLB targets continues to limit market growth. The risk isn't that companies aren't trying to hit their targets. It's that the targets were set without adequately modeling the infrastructure constraints that determine whether they're achievable on the stated timeline. What sustainability reporting obligations apply when grid constraints cause milestone misses? The challenge extends beyond the financing terms themselves. Companies facing grid-constrained execution gaps have a disclosure question to navigate. When a milestone is missed because the grid couldn't support the electrification project on schedule, how that is characterized in sustainability reporting and investor communications matters for both credibility and emerging disclosure regulatory frameworks. The International Capital Market Association's sustainability-linked bond principles provide guidance on KPI selection and verification, but don't address the specific scenario where a milestone is missed due to infrastructure constraints outside the issuer's control. That gap is creating real uncertainty about how to handle forced milestone misses transparently without triggering investor concern that is disproportionate to the actual cause. How to structure sustainability-linked financing KPIs to account for grid infrastructure risk. Finance and sustainability teams renegotiating or newly structuring sustainability-linked instruments in the current environment are approaching milestone design differently. The most important change is building infrastructure conditionality into KPI definitions, explicitly acknowledging in the instrument structure that certain electrification milestones are contingent on utility interconnection timelines, and defining a mechanism for timeline adjustment in the event of documented grid access delays. Some issuers are shifting toward milestones that are more fully within their operational control. Energy intensity targets, renewable energy procurement ratios, or efficiency improvements that don't require specific grid access to execute. These may not carry the same investor signal as an electrification commitment, but they produce financing structures that are less exposed to infrastructure risk factors outside the company's direct influence. The broader lesson is about the gap between ambition and execution in sustainable finance. Setting bold sustainability targets is valuable. Financing those targets without accounting for the infrastructure realities of achieving them creates financial exposure that was never priced into the original cost of capital. In a tighter credit environment, closing that gap isn't optional. It's the precondition for sustainability financing structures that actually hold up. You've been listening to Sustainability Soundbites by Environment and Energy Leader. For partnership opportunities, please reach out to our team.